I'll admit, and I think this is just maybe my bias a little bit as an investor and investment manager. I find the most appeal in some of the closed-end funds that are, frankly, relatively simple, plain vanilla. So today's closed-end fund landscape to me has gotten really interesting. We have this sort of very wide array of choices out there. So on the one end, choice is nice. Certainly as investment managers, we like to have a lot of choices about how we're going to invest client money. The challenge on the other end, though, is that means, to me, there's really a high due diligence burden around closed-end funds to figure out, so what exactly are we buying? What is it that we're trying to achieve with it? And how does it fit in the context of the portfolio? So is this an alternative to something else that we are owning? Is this simply another vehicle for owning what maybe we would have already? We just think a particular closed-end fund provider and manager does it especially well in this certain package. So to me, really the starting point around a closed-end fund is to just have some bearing, I think, for yourself as the investment manager of why are we going down this road? Is it a particular manager we're trying to get access to? Is it a particular type of investment we want to hold that's best in this manner? Is it because we just think the vehicle is better for holding this investment? What are we trying to accomplish with it? And then we can start to look at the due diligence of a particular offering and say, all right, where or how does this fit in the portfolio or not? Certainly one of the areas that we see closed-end funds getting used is around, sort of broadly speaking, stuff that spins off income and cash flow. So maybe that's bonds, maybe that's even some other types of alternatives that can be structured around income and cash flows. I think certainly that's appealing in today's world. The thing that always worries me in the closed-end fund context, and really just investors going for income in general, is some of the hazards that tend to come up around stretching for yield. Certainly I think there's an appeal for trying to drive up better risk return out of getting yield and getting cash flow. But to me, the balance that you really have to be careful of around closed-end funds, or really just any sort of environment where we try to stretch for yield, which is popular when yields are as low as they are, is to be cautious that you're not introducing other risks or other complications in the portfolio. If you can just find a closed-end fund that is a more appealing way to carve up a particular investment space and say, I've just analyzed it and this gives a better risk return reward, absolutely that's appealing, simply because I always want to put things in my portfolios for clients that have better risk return balances.
For more information and data on closed-end funds, visit our sponsors at efconnect.com, the authority on closed-end funds. Thanks for watching. This is Closed-End Fund News.